Hi, Mark Anderson here, mortgage banker with Paramount Bank. I'm licensed to lend in all 50 states, and I would love the opportunity to earn your business. So today is the first mortgage rate update in about a week, and I probably really shot myself in the foot by not doing these videos because over the past week, the rates have been incredibly good. They have been essentially at the lowest levels that we saw back in early March. Maybe for some scenarios we weren't quite as low as that, but we pretty much hit that same price level in terms of interest rates. It was very good to see, but because that happened, I got incredibly busy, many new locks that I had to put on, and of course I had to take care of my existing clients. So unfortunately, I just didn't have the time in my day to get these videos done. That really did probably shoot me in the foot because it would have been a really good time to let people know what was going on in the markets. But that said, I'm back, and for today's mortgage rate update, unfortunately, I've got kind of semi-bad news, and that's that the mortgage rates have started to come up by a little bit. What we have in the market, what's impacting the bond market right now, is the US Treasury Department issued a new series of bonds. Now, not to get super uber technical, because some of these super uber technical things are over my head, but from what I understand, you essentially have some basic supply and demand forces that are still at play, even though this market, in my opinion, is fundamentally artificial given the Fed's role in propping up these mortgage bond prices. But you still have some basic supply-demand factors that are driving what's going on in the market still. And essentially, if you're a long-term bond or you're a bond investor and you're buying long-term bonds, you can buy mortgage bonds. Those are your typical baseline long-term bonds. But the US Treasury Department came out this week and announced that they are doing a large amount of long-term US Treasury bonds. So essentially there is some more competition in the space. And given that we were already having some liquidity concerns, the Fed is buying these bonds for a reason because there just wasn't enough liquidity in this market to keep things going. We now have some additional competition in it. And that alone, in my opinion, has pushed these mortgage bonds down in price. And when mortgage bond prices go down, of course, interest rates do have a tendency to go up. And that is unfortunately what we're seeing. This is over the last 5 days. You see back here at the end of April, we had these sustained bond price levels on this 30-year 2.5% coupon of over 104. We saw that on a sustained basis day after day after day, and it did ultimately bake into the big mortgage investors reducing their rates to be somewhat commensurate with these bond prices. Now, with these new Treasury bonds coming into the market, that's had an immediate effect on bond prices. It's pushed them down. This is a couple days ago, May the 4th, we got below 104, and then down today, we are a little bit lower than 103.8 at the present time. You'll see on your screen, I've got stair steps there. I put this feature into place because I have found it frustrating, and I know it's frustrating from a viewer standpoint, that I can't actually quote rates on the mortgage rate update. Now, there are some compliance reasons for that. Basically, anytime if I were to quote a rate online, I would have to include a lot of fine print, which doesn't translate well into video. But there's also the practical reality that mortgage rates are going to be different on the day, on the loan amount, property state, loan to value, credit score, cash out or non-cash out or purchase. Many different factors go into those rates. There is no such thing as the rate on any given day. So the practical considerations, the compliance considerations, basically I can't quote rates in these videos. But what I can do is tell you relatively where they are at today versus where they've been before. So the bottom of this step is going to represent the lowest rates that we have seen over the last 45 days. So that's early March, and then recently this past week we got, I'm going to say at that bottom step. We are now 2 steps above that. And what I'm trying to represent with these steps is, generally speaking, 1/8 of a percentage point per step in terms of the average rate. Again, I'm not quoting a rate for the reasons that I mentioned, but I think that that will be a useful way to give you a relative basis for the understanding when I say rates are up today or rates are down. So I'm going to experiment with that. I think it'll work out pretty well. As far as predictions, if you've seen my videos, I'm very leery to make predictions. I think that it's in fact probably irresponsible to make predictions. It's fair to talk about things in terms of probabilities. At the present time, I think it is more probable over the next, let's say, 3 to 5 business day period, it's more probable than not that rates will continue to get slightly worse, as I think that the mortgage bond prices are going to get slightly worse day to day. The big question, as always, is if that prediction turns out to be correct, and we do have a period of time where the mortgage rates come up for a period of days, the question at that point is, well, is there going to be something that's going to push them back down? It's possible. We have seen a generally cyclical pattern of rates going up and down. I wouldn't say it's on a perfect sine wave by any means, but we've seen them go up, we've seen them go down, and we've seen that cycle generally take place over the span of, between, let's say, 7 and 14 business days. We've seen those rates come up and down over time. The big issue is whether we're going to see that cycle get us back down to the lowest levels that we were at. Here's some food for thought. The lowest rates that we had, and I'm going to blow this chart out to the 3 months so we can get back to early March. This, and I've shared this chart many times, this is March the 6th, bond price at 102.61. We saw the rates shoot down to their lowest ever, record levels that they've ever been according to Freddie Mac. That we're calling step one on our stair steps here. Rates got worse in this period here. The Fed got involved. Bond prices shot up. And during this entire time where we saw bond prices hovering around 104, we actually did not get back to the levels that we had as far as mortgage rates were concerned back here in early March. We didn't get back there until right about here at the end of April. So there was a long period of time there where rates were going up and down, and we did not get to the lowest point until almost 2 months after the initial drop. Now, a lot can happen in 2 months, and there are a lot of things that could impact this bond market. There are a lot of things that are impacting the mortgage market right now. I would say from a, let's say, short to medium term prediction standpoint, the rates are still incredibly, incredibly low right now. They're much lower than they were, let's say, 2-3 weeks ago. So I think, again, if you're in a position where maybe you missed the boat back in March, maybe you missed the boat at the end of April here, I still think that the risks favor locking in. If you've got a rate where you're still going to see a significant benefit to lock at the rates that are at right now, get it done. Lock in those savings. Move on with your life. But I will, of course, keep you apprised. I'm going to really try hard to get back into the habit of doing these videos consistently on a day-to-day basis. Please do like the video. Subscribe to my channel. I am going to be rolling out some new content. I actually worked this past weekend on some new educational content that I'm going to be doing on the channel. I'm going to be doing a reaction video because I hear those are popular. So I'm going to do a reaction video to some mortgage in film scenarios. And so just subscribe to the channel, like the video. Thank you for watching. Please let me know anytime if you'd like me to look at your scenario. You can call or text me at the number below. Thank you very much.